All right, for accounts payable, the primary assertion at risk is understatement. Which assertion should drive plan procedures? All right, let me walk this one all the way out. When I think about accounts payable, I know management's natural bias. They'd love to show less debt than they really owe. No one brags about their bills. That means the risk is understatement. And which assertion speaks directly to understatement? Completeness. Now let's look at the choices one by one. Option A, classification. This asks whether liabilities are in the right place, current versus non-current, or AP versus accrued expenses. Misclassification can mislead, but it doesn't address the core risk that some payables might not be recorded at all.
So, not the main driver. Option B, completeness. Bingo. Completeness is all about making sure that everything that should be in the books actually got there. When AP is understated, some liabilities are left out. So my planned procedures need to target completeness, like searching for unrecorded liabilities, reviewing subsequent cash disbursements, reconciling vendor statements, and inspecting unmatched receiving reports. Option C, presentation. This covers whether the disclosures and line items are shown properly. Important at the end, but presentation doesn't prevent understatement. Option D, rights and obligations. This asks whether the company really owes what's recorded.
Useful for other areas, but if the problem is understatement, then the issue isn't about fake liabilities, it's about missing ones. Correct answer? Option B, completeness. Here's how I keep it straight. For assets, like AR, the risk is usually overstatement. Focus on existence. For liabilities, like AP, the risk is usually understatement. Focus on completeness. So in my head, it's like management is trying to polish the window, assets look bigger, and hide the bills under the rug, liabilities look smaller. My audit plan is built around lifting the rug, testing completeness for payables. Moving on to the next question. A SOC 1 Type 2 report for the payroll service lists complementary user entity controls, QUCs, including maintaining current employee master data and reviewing output reports. How should the auditor plan the response? Option A, rely on the bridge letter to cover all QUCs. Nope, a bridge letter only covers the gap period between the report date and year-end. It doesn't magically say, oh, by the way, the client also did their part with QUCs. Option B, test whether the user entity has designed and implemented the QUCs relevant to the audit. Yes, that's the right approach. QUCs are the client's responsibility. The service org's controls only work if the client does its part, like keeping employee data current and actually reviewing those payroll reports. As the auditor, I need to plan procedures to test that the client has these QUCs in place and operating. Option C, ignore QUCs because they belong to the service organization. Nope again. By definition, QX are the user entity's responsibility, not the service organization's. I can't just brush them off. Option D, request the service auditor to test the user entity's controls. Not possible. Service auditors test service org controls, not the client's. It's my job as the user auditor to look at QX. Correct answer? Option B. Whenever I see QX in a SOC 1 Type 2, my brain says, the service org did their part, now make sure the client did theirs. If the client didn't maintain employee master data or review payroll reports, that SOC 1 assurance doesn't mean much. Question. The external auditor considers using internal audit's work over procurement controls. Which factor set best support reliance? Option A. Internal audit is outsourced. Therefore, independence is guaranteed and no evaluation is needed. Nope. Just because it's outsourced doesn't mean I can skip evaluation. I still have to consider competence, objectivity, and quality of the work. Independence is not automatic. Option B. Internal audit reports functionally to the audit committee. Work is supervised and well documented. Yes, this is the strongest support. Reporting to the audit committee enhances objectivity, and if the work is properly supervised and documented, that ticks the boxes for competence and quality. When I think about relying on internal audit, my mental checklist is objectivity, competence, and quality of work. Reporting to the audit committee plus solid current documentation hits all three. Here's a simple mind map for relying on internal audit work. Key factors to evaluate. Objectivity, who do they report to? Audit committee equals strong. Controller/management, weak. Competence, professional qualifications, training and experience. Work quality, supervision in place, well-documented procedures, timely, not 18 months old. Relevance, does their work cover the current audit area? Procurement controls in this case. Best support for reliance equals objectivity plus competence plus quality plus relevance. In the question, that was reporting to the audit committee plus supervised and documented work. Question. A manufacturer has 6 locations contributing varying percentages of revenue and inventory. Controls are centralized. 2 sites are new. Which planning approach is best? Option A, limit testing to centralized controls and rely on walkthroughs from one major site to represent all. Tempting, but too risky. Centralized controls are important, but locations can have unique risks, especially with revenue and inventory. One site won't represent the whole company. That's like tasting one cookie and assuming the whole batch baked the same. Option B, select locations based on significance and risk, including new sites, and tailor procedures. Use centralized control testing where appropriate. Yes, this is the sweet spot. Significant and higher risk sites get direct attention, including those new ones, because new equals higher risk, while centralized controls can be tested once and applied across sites where relevant. This balances efficiency and audit coverage. Option C, include every site in scope with full procedures to ensure complete coverage regardless of size or contribution. That's overkill. Why audit the broom closet like it's the warehouse? Materiality and risk help us avoid wasting audit hours. Option D, focus only on the 2 new sites, assuming established locations have no material risk if controls are centralized. Too narrow. Old sites still matter, especially if they contribute a big chunk of revenue or inventory. Ignoring them is like only checking the new tires on a car while assuming the old ones can't blow out. Correct answer, option B. Whenever I see multi-location audits, I remind myself, go where the money and risk are. Centralized controls help, but risk-based selection is the gold standard. Here's the crisp summary straight from relevant standards. During walkthroughs of the revenue process, what is the auditor primarily trying to achieve? Option A, select samples for year-end substantive testing? Nope. A walkthrough isn't about picking samples. It's about tracing a single transaction start to finish to see how the process works. Option B, replace tests of controls for the remainder of the audit. Not at all. Walkthroughs don't substitute for real control testing. They help me understand the process, not conclude it's effective. Option C, prove that controls are operating effectively throughout the period. Too strong. A walkthrough might give me a snapshot, but it doesn't prove operating effectiveness over time. Option D, confirm the auditor's understanding of the flow of transactions, points where misstatements could occur, and relevant controls. Yes, that's exactly it. In a walkthrough, I follow one transaction from initiation through recording to confirm my understanding of the system, identify risks, and locate key controls. Correct answer? Option D. When I do a walkthrough, I imagine myself as the transaction itself, like a dollar bill traveling through the company, bumping into approvals, invoices, shipping docs, and journal entries. My job is to see where that bill could get lost, misstated, or messed with. Here's a quick comparison table you can drop into your reviewer notes. Moving on to the next question. When are substantive analytical procedures most suitable as a planned response? Option A, when there is predictable, stable relationship and reliable data to develop an expectation. Yes, this is the gold standard. Analytical procedures work when life is boring and predictable. Think payroll. If I know headcount and pay rates, I can pretty much predict total payroll expense within a few dollars. Same with rent expense. Stable contract, same monthly amount, easy to expect. The key is reliable data and a logical, stable relationship. That's when analytics shine like a calculator on fresh batteries. Option B, when relationships are random and data are volatile. Nope, if the data's jumping around like a karaoke singer hitting random notes, I can't form a solid expectation. Analytics in this case would just give me a headache and no assurance. Option C, when only a few transactions exist with large variations. Also no. If there are just a handful of big, unusual transactions, I don't need analytics. I need to vouch those babies one by one. Doing analytics here is like trying to predict the weather based on two random clouds. Option D, when controls are weak and a count is highly subjective? Again, no. If the account is subjective, say an allowance for doubtful accounts or a complex fair value, analytics can't give me strong comfort. That's when I need to roll up my sleeves and dig into assumptions, estimates, and supporting evidence. Correct answer, option A. Here's how I keep it straight in my head. Substantive analytics are like GPS. If the roads are stable and mapped out, predictable relationships, reliable data, GPS will take me right where I need to go. But if I'm driving through a jungle with no map, random, volatile, subjective accounts, the GPS is useless. I'll need to get out and walk the path myself with detailed testing. All right, let's really unpack this one. Question: which data analytic procedure best supports risk assessment over journal entries? Option A, confirm all JEs with the general ledger software vendor. Nope, the software vendor doesn't know or care what your client books. They only sell the system. Asking them to confirm entries is like asking the car dealer if you ever sped in your car. Wrong party, wrong evidence. Option B, test a haphazard single entry from each month. This is the audit equivalent of sticking your finger in one cup of soup and assuming the whole restaurant tastes fine. One entry per month? That won't cut it. It's not risk-based, not representative, and misses the whole point of analytics. Option C, rely on management's dashboards without independent validation. This is where auditors get into trouble. Management dashboards can be flashy, pretty graphs, neat colors, but if I don't test the underlying data, I'm basically trusting management to grade their own homework. No thanks. Option D, scan the entire JE population for unusual combinations of user, time, and account, then target outliers. Yes, this is the star of the show. Standards AUC 240/ISA 240 require auditors to address the risk of management override through journal entry testing. Data analytics let me do exactly that, scan the entire population, not just a few cherry-picked samples. Then I filter for anomalies, entries posted at midnight on New Year's Eve, journal entries by someone who normally doesn't touch the books, like the CFO instead of accounting staff, odd account combos, debits to revenue, credits to cash in strange ways, big round dollar entries posted right before covenant calculations. Those outliers are where fraud or misstatement usually hides. Correct answer? Option D. Here's how I frame it in my head for exams. If the option smells like lazy audit work, haphazard, relying on management, irrelevant confirmation, throw it out. If the option screams all data plus focus on the weird stuff, that's the winner. And journal entries, the devil hides in the outliers. So scan everything, then chase the oddballs. Moving on to the next question. Which documentation best meets requirements for risk assessment and planned responses? Option A, a checklist with boxes ticked. This is the lazy audit cousin. Sure, it shows I looked at something, but it doesn't demonstrate I actually understood the process. Think of it like checking, yes, I read the book, when you only skimmed the back cover. Audit standards, AUC 315/ISA 315, expect more than just ticks. They want documentation that shows comprehension, risks identified, and how I'm responding. Option B, only copies of invoices tested later. Nope, those invoices are part of substantive testing evidence. But for risk assessment, I'm supposed to show what the process is, where misstatements could sneak in, and what I plan to do about it. Invoices alone are like handing in your exam answers without showing the study notes. The grader doesn't see your reasoning. Option C, narratives, flowcharts of significant processes, identified risks by assertion, and linkage to planned procedures. Yes, this is the gold standard. This kind of documentation tells the whole story. Narratives/flowcharts equals how the process works, the movie. Identified risks by assertion equals where things could go wrong, the villains. Linkage to procedures equals how I'll fight those risks, the battle plan. This ties directly to what the standards want. Risk assessment procedures, plus identified risks of material misstatement, plus the planned responses. It's risk-based auditing in action. Option D, an email from management describing processes. Sounds convenient, but it's management's view, not mine. The standards say the auditor has to document their own understanding, not just copy-paste management's email. At best, this is supporting info. It doesn't meet the requirement by itself. Correct answer, option C. When documenting risk assessment and planned responses, the goal is to show I understand the process, flowcharts/narratives, show I identified risks tied to assertions, existence, completeness, etc. So I linked audit procedures to those risks, substantive tests, controls tests. Next question. Management revised the model for allowance for credit losses to lower expense this year. What planned action best addresses the risk of management bias? Option A, review whether the revised estimate is consistent with prior results and industry norms. This is a nice to do, but not enough. Why? Because management can cherry-pick assumptions that look normal, but are still biased in subtle ways. Imagine someone saying, my exam score is consistent with the class average. Sure, but maybe the whole class bombed the test. This option is only a piece of the toolkit. Option B, evaluate whether management's internal controls over the model design and approval are operating effectively. Good step, but again, too narrow. Testing controls over design and approval is like checking the lock on the cookie jar without actually looking inside to see if cookies are missing. It doesn't directly address the numbers coming out of the model, which is where bias lives. Option C, test the model's methods, data, and key assumptions. Perform a retrospective review and involve a specialist if appropriate. This is the full playbook and exactly what AUC 540/ISA 540 revised. Let's break it down. Test methods. Is the model's design appropriate? Does it follow the applicable framework? Test data. Are the inputs complete, accurate, and relevant, e.g., borrower credit histories, default rates? Test assumptions. Are the assumptions reasonable? Or are they overly optimistic, like assuming every customer will suddenly become a perfect payer? Retrospective review. Compare management's past estimates with actual results. If they've consistently been off in the same direction, too rosy, that's bias waving at me. Specialist involvement. If the model is complex, and credit loss models often are, I may need to pull in a valuation or credit risk specialist. This option tackles bias head-on. It's not a sample, not a shortcut, but the full risk-based approach. Option D. Assess whether the estimate falls within a reasonable range developed using alternative assumptions or scenarios. This one's solid. Developing your own range is a classic audit move.
But notice, it's only one slice of the pie. It doesn't cover testing management's methods, data integrity, or retrospective reviews. Think of it as one strong tool, but not the whole toolbox. Correct answer, option C. When I see management estimate plus possible bias, my brain runs through this sequence. Understand the model, method, and framework. Test the data, completeness, accuracy, relevance. Test assumptions, reasonableness, consistent with external data. Retrospective review, how good were management's past estimates. Independent range or point estimate, develop my own expectation. Specialist involvement if complexity is high. Evaluate for bias indicators. Are assumptions consistently skewed in one direction?
Check disclosures. Are uncertainties explained clearly?
Next question. A new ERP went live. An IT general control weakness was noted. No periodic access recertification. What is the most appropriate planned response? Option A. Assess control risk as high for affected processes and increase substantive testing at year-end. Yes. No periodic access recertification equals who knows who still has access. Former employees, terminated contractors, or folks who shouldn't touch the system may still be in there. That undermines reliance on system-based controls. So the safest and standards-aligned move is to crank up substantive testing at year-end, especially over financial reporting that flows through the ERP. Option B. Perform walkthroughs and limited inquiry, but continue to place moderate reliance on automated controls. Nope. Inquiry and walkthroughs don't fix a known ITGC weakness. Once access controls are questionable, relying on automated controls is risky, like trusting a lock when everyone has a copy of the key.
Option C. Evaluate compensating controls, such as user activity monitoring, and, if they appear reasonable, reduce substantive procedures. Tempting, but weak. Unless I thoroughly test those compensating controls, and they're strong, I can't just reduce substantive procedures. This is too casual for the risk. Option D. Consider last year's ITGC results to support some reliance on system controls, since the overall ERP environment is similar. No way. A new ERP went live. Last year's system results are ancient history. That's like saying, my old car passed inspection, so this brand new one must be fine too. Correct answer, option A.